Silver didn't just go up, it broke something. In a market that usually moves in inches, silver moved in free fall, straight up, from around $50 to $90, not over years, not over months, but in a burst so fast it caught even long-time insiders flat-footed. Here's the contradiction. Everyone expected higher prices someday. Almost no one expected the market itself to lose control. And this isn't just about traders. This reaches you. Silver isn't some abstract metal on a screen. It's inside phones, power grids, solar panels, defense systems, and the financial plumbing that keeps prices stable. When silver reprices like this, it's a signal that something deeper than supply and demand just snapped. What's disturbing isn't the number 90, it's how it got there. No resistance, no orderly pullbacks, sellers didn't step in, the sell side simply disappeared, prices went vertical because there was nothing left to slow them down. But here's the part nobody is saying out loud yet. Moves like this don't start with excitement. They start when a system quietly fails, and the market realizes it too late. And once you see what failed first, this doesn't look like the top of a rally anymore. It looks like the opening breach. What actually happened here didn't begin at $90. That number is just where the damage became visible. The real event started earlier, when silver stopped behaving like a normal commodity and started acting like a constrained system under stress. At the start of this year, silver wasn't drifting higher. It was forced higher. The price didn't climb because sellers changed their minds. It climbed because buyers couldn't find metal. In a market that depends on constant physical flow, that's a red flag. Silver jumped through levels that had capped it for decades, not after long debates or gradual acceptance, but in a compressed window that left no time for adjustment. This wasn't an isolated spike. It fits a pattern we've seen before when a resource quietly moves from available to strategic. When that happens, prices don't negotiate. They gap. And when the gaps keep coming, the market is telling you something structural has shifted. Here's the question most coverage avoids. If silver is just responding to demand, where did the supply go? And if supply didn't vanish overnight, why did the market suddenly act like it had? Because this story isn't really about silver, it's about control. And once control enters the equation, prices stop behaving politely. Here's the claim that changes how this move has to be read. This wasn't a speculative surge, it was a physical one. The facts are blunt. Silver didn't grind higher through resistance. It leapt. The price moved from roughly 50 to 90 in what insiders described as an aggressive, almost violent repricing. That kind of velocity only shows up when the market can't find metal to sell. Not unwilling sellers. No sellers. The sell-side order book effectively evaporated. Buyers kept hitting bids, and there was nothing left to absorb them. That detail matters more than any headline. In a healthy market, rising prices attract supply. Here, higher prices did the opposite. They exposed how little accessible silver was actually available. Industrial users didn't buy because they wanted upside. They bought because they needed inventory. Covering demand doesn't wait for pullbacks. Now notice what's missing. There was no cascade of profit-taking, no wave of supply rushing in to meet the price. That silence tells you this wasn't excitement. It was urgency. What this implies is unsettling. If 90 was reached without panic selling, then the price didn't clear excess demand. It revealed a shortage, and shortages don't resolve themselves politely. They force repricing until behavior changes. This is where the story flips, because if this were just about enthusiasm, it would already be over. But enthusiasm doesn't empty warehouses. Something else did. Once that shortage became visible, the situation stopped being financial and started becoming systemic. Because when a market realizes supply isn't elastic, behavior changes fast. Buyers stop optimizing price and start optimizing access. That's when escalation begins. Silver didn't just move higher. It normalized something that shouldn't be normal. a strategic metal trading as if it were suddenly off limits. We've seen this movie before, not with silver, but with other materials that quietly crossed from commodity into leverage. When that line is crossed, governments get involved, approvals replace contracts, and timelines stretch. What used to flow freely starts moving only with permission. The market doesn't wait for confirmation, it prices the risk immediately. That's what's happening here. The speed of the move tells you the market isn't debating probabilities anymore. It's adjusting to a new baseline under pressure. And once a metal enters that zone, volatility stops being a phase and becomes a feature. Here's why that matters. When abnormal conditions repeat, they stop feeling abnormal. $90 silver is shocking the first time, less so the second. Eventually the shock wears off, but the price stays elevated. That's how repricing locks in. This is where the story accelerates, because supply stress doesn't exist in isolation. It collides with politics, conflict, and policy all at once, and when that collision happens, prices don't cool. They cascade. Here's the evidence that makes this impossible to ignore. The words stayed calm, the actions did not. Publicly, everything sounded controlled. No official panic, no dramatic announcements, but behind the scenes, behavior told a different story. Buyers weren't negotiating long-term contracts. They were scrambling for immediate delivery. Physical silver wasn't being marketed. It was being withheld, delayed, rerouted. That contradiction is the tell. When language stays soft, but access tightens, something structural has changed. And here's the detail that reframes the entire move. Silver didn't surge because investors suddenly loved it more. It surged because a major refining choke point effectively stopped behaving like a neutral supplier. When approvals replace automatic flow, the market fragments. Metal that exists on paper no longer equals metal you can actually get. Notice what wasn't denied. No one stepped forward to say supply was abundant. No one reassured the market that inventories were healthy. Silence filled that gap. And markets treat silence as confirmation. This is the moment that permanently changes how you see the price. 90 isn't a peak driven by excitement. It's a forced clearing level in a market adjusting to restricted access. That means future prices aren't anchored to yesterday's charts. They're anchored to availability. And once price is driven by access instead of sentiment, the next move stops being optional. It becomes inevitable. At that point, the pressure stopped building in one place and started stacking everywhere at once. First, industrial users accelerated purchases, not because they wanted exposure, but because waiting became riskier than paying up. Then logistics slowed, deliveries stretched, lead times expanded. What used to be routine turned uncertain almost overnight. At the same time, financial markets tried to keep up, repricing contracts while the physical side lagged behind. That gap is where stress lives. None of this unfolded slowly. It compressed. Decisions that used to take months were made in days. Risk managers stopped asking where the price should be and started asking whether supply would be there at all. That's a loss of control moment. When speed replaces planning, systems start to fray. Now watch how fast this escalates. As prices climbed, instead of easing pressure, they amplified it. Higher prices validated the fear. Fear pulled demand forward. Pulled forward demand drained availability even faster. It became a feedback loop, and feedback loops don't stabilize on their own. So here's the question that matters more than any forecast. What happens if this doesn't pause? If access stays constrained, if decisions stay rushed, and if the market never gets the reset it's waiting for? Now bring this down to where it actually hits you. When a metal like silver locks up, the impact doesn't stay inside trading screens. It bleeds outward. Prices don't just move for investors. They move for manufacturers, utilities, and anyone downstream who depends on stable inputs. When silver becomes scarce or unpredictable, costs don't rise gradually. They jump, then ripple. That shows up as delays. Products take longer to ship, repairs take longer to complete, energy projects slow down, companies quietly change specs, cut margins, or pass costs forward. You don't see a headline that says silver shortage, you feel it when prices stop making sense or timelines stop being reliable. And here's the uncomfortable part. None of this requires a full-blown crisis to hurt. Even partial disruption is enough. Once uncertainty enters the supply chain, everyone prices in protection. That protection shows up as higher costs for you, whether you notice the cause or not. If this feels familiar, say so in the comments. Because most people only realize how dependent systems are after something breaks, and by then the repricing is already done. But the bigger story isn't about inconvenience. It's about why these systems keep reaching breaking points in the first place. To understand why this keeps happening, you have to stop thinking in terms of shortages and start thinking in terms of incentives. Modern systems aren't built for resilience, they're built for efficiency. Inventory is minimized, redundancy is cut, everything works perfectly until it doesn't. When a resource is abundant, that structure looks smart. When access tightens, it becomes fragile almost instantly. Silver sits at the intersection of that fragility. It's industrial, monetary, and strategic at the same time. That combination makes it sensitive to pressure from every direction. A small policy shift, a delay at a refinery, or a surge in demand doesn't just move price. It exposes how little buffer exists. Here's the unsettling insight. Markets don't break because of one bad decision. They break because systems are optimized to the edge, with no room for surprise. When something unexpected happens, price is the only release valve left. This is why coverage that treats this as hype misses the point. The mechanism isn't speculation, it's leverage. Whoever controls flow doesn't need to speak loudly. The system responds on its own, and once markets learn that lesson, they don't unlearn it. The behavior changes permanently. From here, the path forward splits, and neither option is comfortable. One path assumes pressure eases, supply loosens, approvals speed up, and the market finally gets the pause it's been expecting. Prices pull back, not because the problem vanished, but because the urgency briefly fades. That would calm headlines, but it wouldn't undo what's already been learned. Once markets discover fragility, they don't go back to pretending it isn't there. The other path is more destabilizing. Constraints persist. Access stays uneven. Each pullback gets bought faster than the last because no one wants to be caught without coverage. In that scenario, 90 doesn't act like a ceiling. It acts like a reference point. Volatility increases, not decreases, and the next move forms quietly before anyone admits it's coming. Here's what makes this moment dangerous. Both paths carry momentum. The market is already leaning forward, watching for confirmation. And confirmation doesn't arrive with announcements. It arrives through behavior, delays, premiums, and who gets metal first. The next move hasn't been announced yet, but the conditions that force it are already in place. Here's the insight that ties this entire story together. This wasn't a silver rally, it was a stress test, and the system didn't pass. The price didn't rise because people changed their minds. It rose because access changed. That distinction matters because sentiment can reverse. Structure doesn't. Once a market reprices around availability instead of optimism, the old anchors stop working. Charts, averages, and historical ceilings lose authority. What replaces them is behavior. Who moves first, who hesitates, and who gets locked out. That's why this moment lingers. Even if prices fluctuate, the lesson stays embedded. The market now knows where the weak points are, and once that knowledge spreads, it doesn't disappear. It compounds. This story isn't finished, it's unfolding. The next phase won't announce itself with a spike. It will arrive quietly through decisions made under pressure, away from the spotlight. If you want to understand those moves as they form, not after they're obvious, follow this channel. Because the most important shifts don't happen when everyone is watching. They happen just before.